Okay, so last time we discussed about section 27. Now we go to section 28. Section 28 is all about rates of income tax on foreign corporations. So first we'll go to tax on resident foreign corporation. Okay? You remember that resident foreign corporations are also subjected or subject to MCIT. Where do you find that? Subparagraph 2. Minimum corporate income tax of 2% of gross income as prescribed under Section 27E of this code shall be imposed under the same conditions on a resident foreign corporation taxable under paragraph 1 of this section. So it's not only the domestic corporation that is subjected to MCIT, but also resident foreign corporation or RFC. Now, you, there is this more important provision, subsection or subparagraph 3, international carrier 2.5% gross Philippine billings. There is this case, South African Airways versus Commissioner of Internal Revenue. What happened here? It was decided in February 16, 2010. As you remember that whenever an international carrier does business here in the Philippines, it is subjected to 2.5% gross Philippine billings. So this is like a preferential tax rate also. That's just 2.5% gross Philippine billings for only for international carrier or the vessels. The South African Airways claim that because they don't have any flights from the Philippines. Okay, so we'll go first. What is the meaning of the gross Philippine billings before we discuss South African Airways? So let's go there. So gross Philippine billings refers to the amount of gross revenue derived from carriage of persons, excess baggage, cargo, and mail originating from the Philippines in continuous and uninterrupted flight, irrespective of the place of sale or issue and the place of payment of the ticket or passage document, provided the tickets revalidated, exchanged, and or endorsed to another international airline form part of the gross Philippine billings if the passenger boards a plane in a port or point in the Philippines. Provided further that for a flight which originates from the Philippines but transshipment of passenger takes place at any part outside of the Philippines or on another airline, only the aliquot portion of the cost of the ticket corresponding to the leg flown from the Philippines to the point of transshipment shall form part of the gross Philippine billings. So this, we go back to the South African Airways. The South African Airways said, we don't have any flights here. There's no carriage of passengers, there's no baggage, etc., etc. So we are not liable for 2.5% gross Philippine billings. According to subparagraph 3. The Supreme Court said, but you derive income from other activities, such that you would be taxed for the 30% flat rate of the resident foreign corporation as provided in Section 28A. That is the import of South African Airways. But if they don't really have any income, so what are they doing here? Hawa na lang sila eh. Sa may negosyo nila diri. Anyway, so you also have these offshore banking units. You just familiarize yourselves with this. It's subparagraph 4. And this tax on branch profit remittances, 15%. So let's go. There was a question about this in the bar a few years back. So this tax on branch profit remittances. Any profit remitted by a branch to its head office shall be subject to tax of 15%, which shall be based on the total profits applied or earmarked for remittances without any deduction for tax component thereof. Remember that this is all about a resident foreign corporation. Okay? I remember the question was phrased or crafted in such a way that there was a branch in Hong Kong, but it is just a branch of a domestic corporation. And the Hong Kong branch remitted its profit to the Philippines. And the question was, is there a branch profit remittance tax? So, obviously, if you're not really familiar with the provision, you would answer yes. The idea here, class, is that because not a resident foreign corporation, the branch, normally a resident foreign corporation is just a branch of the head office somewhere else, a foreign corporation. So this branch in the Philippines would remit that to its head office, say for example in Norway, where you can see the Aurora Borealis. So now if that branch here, the resident foreign corporation, remits that to its head office in Norway, it would be taxed because it's like taking money, or that money would be sent somewhere else. So our dollar reserves would be less than so much. So we will tax them. It's not the same with the bar question that a branch of a domestic corporation in Hong Kong remits the profit in Hong Kong to the Philippines. So it's more advantageous to us. Why would we tax that? Okay, so just remember, this tax on branch profit remittances pertains to resident foreign corporation. It's not a domestic corporation. Okay? It might be asked again. Now, on subparagraph 6, the RA HQ and the RO HQ. RA HQ, not subject to tax because it doesn't earn income. RO HQ, 10% of taxable income. Okay, just remember that. RA HQ, no tax, doesn't earn income. RO HQ, regional operating headquarters. As defined in section 22, you remember, regional area, it just facilitates like communication, whatever. But ROHQ or ROHQ, operating headquarters, they operate, or the regional operating, they operate their business here. So that means they earn income. That means they should be taxed. Okay? And section 7B, or section 28, subparagraph 7B, second paragraph, you take note of this: income of non-resident individuals or corporation with depository banks under expanded foreign currency deposit system exempt from income tax under RA 9294. Now, on section 28B, non-resident foreign corporation. This is different. First one was a resident foreign corporation, and this one is non-resident foreign corporation. Do not confuse this with resident evil. Non-resident foreign corporation. Non-resident foreign corporation class, because they are non-resident, they are taxed at 30% of gross income. All sources within the Philippines except capital gains subject to tax. Okay? And you compare paragraph 5B with section 28 7D. Okay? Non-resident foreign corporation is taxed at 15% final withholding tax for dividends received from a domestic corporation, while domestic corporation and resident foreign corporation are exempt from intercorporate tax. I repeat, if a domestic corporation issues dividends to domestic corporation or resident foreign corporation, that dividend is exempt from taxes. However, if a domestic corporation issues a dividend to non-resident foreign corporation, that non-resident foreign corporation is taxed at 15%. But that is a final withholding tax. What is our basis? Section 28B, paragraph 5B. So let's go there so that you'll have visuals. Here you go. Intercorporate dividends. Tax on certain incomes received by a non-resident foreign corporation. A final withholding tax at the rate of 15% is hereby imposed on the amount of cash and or property dividends received from a domestic corporation, which shall be collected and paid as provided in Section 57A of this code. Compare that with Section 27 or 28B on paragraph, paragraph A, 27A, okay, or 28A, I'm sorry, 28A, paragraph, let's see, this is, here you go, D, intercorporate dividends. Dividends received by a resident foreign corporation from a domestic corporation liable to tax under this code shall not be subject to tax under this title. Again, there's a difference. Resident foreign corporation tax rate 30%. They are subjected to MCIT. International carriers, vessels, etc., or flights, you remember the South African Airway. If they don't have flights here, they are not taxed at 2.5%. But if they earn income, okay, if they earn income from other activities, but nonetheless earn income from other activities in the country, will be taxed at 30%. That's South African Airways. And RA HQ, area headquarters, not subject to tax because it doesn't earn income. Regional operating headquarters, because they operate, they earn income, 10%. Okay? And tax on branch profit remittances, 15%. This applies to resident foreign corporation class because a resident foreign corporation is just a branch of another foreign corporation here. So if this resident foreign corporation remits its profit to its head office, that's taking away our dollar reserve so much, then we will tax that at 15%. And for paragraph B, non-resident foreign corporation, that's 30% of gross income. Okay? Why? Because they don't have any residence here, right? So that's all sources within the Philippines, except capital gains subject to tax. And because they are non-resident, obviously, whatever that they receive, they won't invest it here. We will tax any dividend that they receive from a domestic corporation at 15%. Final withholding tax. Okay, that's about it for Section 28 on resident foreign corporation and non-resident foreign corporation.